Warren Buffett is with us in Omaha this morning at the Nebraska Furniture Mart. Warren, this is 10 years now that we've been doing the Ask Warren show, where you've let us come out, bring questions from viewers along with us. We want to thank you for that and for taking the time to be with us once again this morning.
It's always been fun.
It has always been fun. We have a lot of questions, as Joe was just alluding to this morning. But why don't we start talking about the letter that was just released on Saturday morning. A lot of people had a chance to look through it. How many is this, 53 for you now of letters?
It's been 52 years.
52?
Maybe 50. Well, I don't know.
It's been more than 50, I remember.
Well, yeah. Been maybe 53, yeah.
All right, so in this letter, you start things off with a message that is a familiar message for you, the American dynamism, just how powerful this country is.
It's unbelievable.
It's a very common message for you, but is there a reason that you chose to put it so high in the letter this year?
Well, I usually put it pretty high in the letter because it's the dominant theme that's run through my life since I bought my first stock in the spring of 1942 when I was 11 years old. And it overwhelms everything else over time. I mean, we have hiccups in the economy, and we even had a panic in 2008. And we had a war during that period. That when I started, we were losing the war, actually, in the spring of 1942. But this country always comes back and wins. And it's astounding when you think about it, what's happened in 240 years. That is less than 3 of my lifetimes. And just look at this place. I mean, there wasn't anything here 240 years ago. And civilization had gone on, for centuries and centuries and centuries with people making very little progress in their lives. And then America showed the way. And we have not lost the secret sauce.
In terms of what the message is you want to get across to people, I mean, when we're looking at markets at such high levels, as Joe was just alluding to, it has a lot of doubters and a lot of people saying, wait, it's too late for me to get in. I've missed it. We're past Dow 20,000. Yeah. Now I have to wait for the pullback. What would you say to someone like that?
Well, I would say they don't know, and I don't know. And if there's a game that's very good to be in for the rest of your life, the idea to stay out of it because you think you know when to enter it is a terrible mistake. I don't know anybody that can time markets over the years. A lot of people thought they can. But if you were buying a farm and you decided that farms were going to be worth more money 10 or 20 or 30 years from now and that it would be a productive asset, you'd go out and buy it unless it was just at some absurd price. And the best thing with stocks actually is to buy them consistently over time. You want to spread the risk as far as the specific companies you're in by owning a diversified group, and you diversify over time. By buying this month, next month, the year after, the year after, the year after. But you're making a terrible mistake if you stay out of a game that you think is going to be very good over time because you think you can pick a better time to enter it.
Although you have had times where you thought stocks were incredibly cheap, like in 2008, 2009, when you talked about that, even on our program. You've thought that there were times that stocks were greatly overvalued, where you've said, forget it, don't do it. Are we near an inflection point right now, as best as you can tell?
Well, I've been talking this way for quite a while, ever since the fall of 2008. I was a little early on that, actually. But I don't think you can time it, and we are not in a bubble territory or anything of the sort. Now, if interest rates were 7 or 8%, then these prices would look exceptionally high. But you have to measure, you measure everything against interest rates, basically. And interest rates act like gravity on valuations. So when interest rates were 15% in 1982, they pulled down the value of any asset. So what's the sense of buying a farm on a 4% yield basis if you can get 15% in governments? But measured against interest rates, stocks actually are on the cheap side compared to historic valuations. But the risk always is that interest rates go up a lot, and that brings stocks down. But I would say this, if the 10-year stays at 230 and it would stay there for 10 years, you would regret very much not having bought stocks now.
Joe, this sounds like a perfect jumping in point for what you had just been talking about, where you were watching what's happening with interest rates.
I think it's, as much as we talk about economic nationalism, it is still global. And I don't know, when the rest of the world's headed one way, it's just, the money's going to come in here for our bonds. And as long as that happens, I guess we stay low. I was thinking about something else, Becky, and I don't want to take this too far afield, but with Warren, I was wondering what it is about us, about the United States, and I wonder that is so different from historically the way countries have prevailed, Warren. And I wonder if eventually we can't just assume we'll always be this dynamic, or is the Constitution and the way they set things up, those guys were that smart, or is it the people that we have? Is it that we've brought in so many people from around the world that came from places where they didn't want to be, and they came to this great spot here? And is it, I mean, have we selected genetically for people that are entrepreneurial and work hard? I don't know. Have you got your finger on what it is? If you don't, I don't know who does. You've had plenty of time to think about it. I mean, you're not old, but you've had a lot of time to consider these things.
Yeah. If you go back to 1790, Joe, there were 4 million people roughly in the United States, of whom 700,000 were slaves. There were 900 million people around the world. So we had at that time 0.5% of the world's population. And it was a friendly country in terms of the soil and the minerals and the temperature and all of that. But there were other friendly spots around the world. And so why did these 4 million people do something that 900 million people hadn't been able to do before, where progress had been very slow? And I would say that it was a combination, none of these perfect, but I think the market system was absolutely essential to it. It was not a planned economy. And I would say that rule of law was important, never perfect, but far more than many places. I would say that equality of opportunity was a factor. I would say that immigration did select for people that, to some extent, selected for people that were ambitious and really wanted a new life. But if I had to pick one thing, I would say the market system was the overwhelming factor that contributed to it.
Life is weird, too, because I think it's weird that Adam Smith wrote that book in 1776.
Yeah, exactly.
That's not a coincidence. That when you're able to own an idea and that you got like a court system that will back up your ownership of patent law, and then you can commercialize it, I think maybe that was it. I think intellectual property and property rights and things like that. Because prior to that, after 10,000 years of spinning our wheels, what was the average GDP per person? And then all of a sudden, starting when you were able to own an idea and commercialize it, suddenly it exploded, GDP, like in multiple times.
It unlocked human potential, Joe. I mean, we aren't smarter now than they were 240 years ago, and we certainly don't work harder. But once you started opening up human potential, it's the sky's the limit, and it's just starting.
There are times, Warren, where you hear pundits or other people saying, look, things are at risk at this point. Our American way of life, our system is under threat. And I've heard this from all sides at all different times. Is there ever a point where you thought that was the case?
No, you say you've heard it at all times from all sides. I've been hearing it all my life. And in the spring of 1942, I was 11 years old, and the Dow was at about 100. And we were losing the war in the Pacific at that point. It was shortly after Pearl Harbor. And there was no doubt in this country we were going to win over time. I mean, and people said, well, let's wait till things are clear. Let's wait till we start winning the war. There's always a reason to wait. And I've listened to that all my life, that when I got out of school, the Dow had never been above 200. There had never been a year when the Dow had not been below 200 during the year. Even in 1929, when it got up to 381, the low was below 200. Never been a year. Well, so what? But that was a big subject at that time. And then we ran into price controls. We ran into the oil shocks. You name it, just all kinds of things. And those are diversions. So. All my life, I've been hearing, maybe there's a better time to invest, or things are more unpredictable now. They're always unpredictable. I can't predict what's going to happen tomorrow. I mean, you could have anything happen tomorrow. We've had October 19th, 1987, 22% down in one day. So I can predict what will happen in 10 or 20 years in a general way, but I have no idea what will happen tomorrow. And the important thing is if you've got these wonderful assets out there, to own them. And which ones do you own? I mean, if you save money, You can buy bonds, you can buy a farm, you can buy an apartment house, or you can buy a part of American business. And if you buy a 10-year bond now, you're paying over 40 times earnings for something whose earnings can't grow. And you compare that to buying equities, good businesses, I don't think there's any comparison. But that doesn't mean the stock market can't go down 20% tomorrow. I mean, you never know what it's going to do tomorrow, but you do know what it's going to do over 10 or 20 years. And people talk about 20,000 being high. Well, I remember when it hit 200, and it was supposedly high. The Dow, the Dow in your lifetime, you're going to see a Dow that certainly approaches 100,000. And that doesn't require any miracles. That just requires the American system continuing to function pretty much as it has.
You had made some headlines when you said maybe a month or two ago that you had spent about $12 billion in stocks since the election. Have you continued to spend since that time?
Well, I'm not sure exactly when I said it, but we've certainly bought in two groups. I'm adding them together now. We spent 14. We probably spent since a little before the election, maybe, because we were maybe 20 billion even.
$20 billion? You're just counting the billions in your head as you sit here doing this?
Well, yeah. I quit when I got to 20.
And why now? Again, is there a reason for this, or is it just you look at individual stocks that you wanted to own and you bought them?
I absolutely look at individual stocks. It has nothing to do with the Federal Reserve. It has nothing to do with the election. It would have something to do with interest rates if they did something extraordinary. It hasn't had, because they haven't changed that much. But there just were a couple of things I wanted to do, and we had the money, and I like investing, and I would much rather have that 20 billion in these companies. And I don't look at it as being in stocks. I look at it as being in businesses. It's just small pieces of businesses. And I would so much rather have that than have the money in treasury bills, which is my alternate. I don't have any problem with the decision at all.
What are the businesses? Should I assume it's Apple and the airlines, based on what we've seen?
I think that's a good guess.
But $20 billion, is that more than what we have been told based on the 13F filings? I'm just going back.
It's more than showed at December 31st, because we spent a lot of money since December 31st.
On what? Is it more Apple, more airlines?
Since we're not buying it now, and it's at a price different than I would buy it now, but we bought a lot more Apple after year end.
The holdings that you had at Apple was it the fifth biggest holding?
I think we showed 59 million or something like that. Sure.
Yeah, I'm sorry. I'm just looking through the report right now to grab that page. It was already your fifth biggest holding as of December 31st at $7 billion. How much more did you buy?
And I'm,
$7 billion.
We could change our mind tomorrow and all of that, but we have not bought Apple in the since the earnings report came out, because it shot up some then. But we would have, there's one of the fellows in the office has about 10 million shares, and I have for Berkshire's account about 123 million. So we got about 133 million shares.
One of the fellows, that's Todd or Ted?
Yeah.
Would you care to say which one?
I never identify which one does which.
So one of them bought, and then you, as a result, bought some additional?
One of them had 10 million shares, and then I bought another 123 million shares or something like that.
Why?
Because I liked it.
You've always said that you're not a technology investor, and now when you start looking through the holdings.
So I'm not a technology investor.
Wait, they can't hold this. Hold that up higher. They can't see it. That's your phone.
There's a vast untapped market out there. 86-year-old guys who haven't got it yet.
So you say you're not a technology investor, but you're buying shares of Apple, which is now Berkshire's fifth, or maybe even larger than that, based on how many that you've put in since then, how many you've bought since December 31st. IBM is your third biggest holding, too.
Well, I would say Apple, obviously it's very, very, very tech involved, but it's a consumer product to a great extent, too. And it has consumer aspects to it. And one of the great books on investing, which I've touted before, is one that Phil Fisher wrote back around 1960 or thereabouts, called Common Stocks and Uncommon Profits. It had an effect on me. I went out to meet Phil Fisher after reading the book. I found him in this little office in San Francisco. And I recommend any investor read that book. And it's still in print, and he talks about something called the scuttlebutt method, and which made a big impression on me at the time, and I used it a lot, which is essentially going out and finding out as much as you can about how people feel about the products that they use. It's just asking questions, basically, and Apple strikes me as having quite a sticky product, and an enormously useful product to people that use it. Not that I do. Tim Cook's always kidding me about that. But it's a decision based. But again, it gets down to the future earning power of Apple when you get right down to it. And I think Tim has done a terrific job. I think he's been very intelligent about capital deployment. And I don't know what goes on inside their research labs or anything of the sort. I do know what goes on in their customers' minds because I spend a lot of time talking to them.
Have you spoken with Tim Cook about this?
No, not about this. Not about this. He would have seen our 13F filing, and he would have seen the one before. So he would have known somebody at Berkshire owned some shares, and then he would have seen the 13F filing. And I usually see him maybe twice a year. I see him at Sun Valley and perhaps one other time.
Wow. Can I ask you? You said it's how many shares that you own? 133.
Well, 133 million.
Yeah. Which I'm sorry. How many did you own as of December 31st that worked out to $7 billion? I can't do that.
Well, I think we had 59 million at year end.
So you've more than doubled it since that time.
That's correct. And we actually, it's amazing how much you can buy of some of these things. So we had bought that, the added 70 million plus. We bought that all by the time they reported their earnings. So it was done probably in 20 business days.
And their earnings were better than people had expected, and the stock jumped as a result. So
yeah, I don't think they were that much better than people expect. I mean, the company
stock was up after the earnings report.
Yeah, it did jump, and that's why we quit buying. We would have probably want more. But the stock, they tell you every quarter what they expect in sales and in gross margins, and they've been pretty accurate on that. So I don't think the fourth quarter, well, it wasn't the fourth fiscal, I mean, it's the December quarter, they're on a fiscal year. I don't think that was that big, or should have been that big a surprise. But they've got an extraordinary business.
Wow.
There's always people trying to knock you off. And the market system, one of the things it does is if you've got something good, you've got a lot of people that are gunning for you.
Right.
And you've got some very smart people that are gunning for them.
You know, we can talk more about this in just a moment, if you don't mind, if we sneak in a commercial break.
Okay.
By the way, for anybody who didn't think we were going to get to big news very quickly, you're already missing a lot. Warren Buffett already telling us he's been buying more stock since the beginning of the year, since the last 13F filings, telling us he's bought more than double the amount of Apple that they had disclosed at that point. Stick around, because you never know what's going to come out of his mouth. We'll be back with more from Warren Buffett in just a moment. Warren Buffett has already told us this morning some secrets that nobody else knew until just now. Warren Buffett and Berkshire Hathaway had been buying a lot of shares of Apple. In fact, as of the end of the year, according to SEC filings and the annual report, it was the fifth largest holding of Berkshire at $7 billion in that stock. Warren just told us that he had continued buying that stock even through the beginning of this year. And at this point, he now owns $17 billion worth of Apple shares. That gives him about 2.5% of the shares outstanding of Apple, and it is now the second largest holding after Wells Fargo for Berkshire Hathaway.
Yeah, it'd be very close, but
very close to Coca-Cola.
Yeah,
very close, neck and neck with Coca-Cola, but it looks like it edges it out, at least where the price is right now. Warren, we were talking a little bit about how you came about this decision. And I assumed you had people who would go out and do some of these channel checks for you and do some of these things. But you just mentioned to me you've done some of the research yourself right here in this building. Well,
I learned that from a fellow named Phil Fisher, who wrote this great book called Common Stocks and Uncommon Profits. And he calls it the scuttlebutt method. And Phil was a remarkable guy. I first used it back in 1963 when American Express had this great salad oil scandal that people were worried about it bankrupting the company. So I went out to restaurants and saw what people were doing with the American Express card, and I went to banks to see what they were doing with traveler's checks and everything. And clearly, American Express had lost some money from this scandal, but it hadn't affected their consumer franchise. So I ask people about products all the time. When I take my great-grandchildren to Dairy Queen, they bring along friends sometimes. They've all got an iPhone, and I ask them what they do with it and whether they can live without it, and when they trade it in, what they're going to do with it. And of course, I see when I come to the Furniture Mart that people have this incredible stickiness up with the product. I mean, if they bring in an iPhone, they buy a new iPhone. I mean, it just has that quality that it gets built into their lives. Now, that doesn't mean something can't come along that will disrupt it, but the continuity of the product is huge, and the degree to which their lives center around it is huge, and it's a pretty nice franchise that with a consumer product.
Hey, Joe, you can relate to that, the stickiness of the product and being hooked into the Apple ecosphere, right?
So many different ways, too. I think it's funny that Warren doesn't have one, but it's weird because you're walking around with the Encyclopedia Britannica on your back, but it's the size of this little thing. And anytime, anywhere, you need to look up anything. I mean, you could be on Jeopardy, and if people didn't see that you were looking at your iPhone, you'd get every question right. And I can listen to every song that's ever been recorded. And I used to live in L.A. and I was afraid to leave the freeways because I had no idea I'd get lost. So I'd just sit in that traffic for like 11 hours to get to go 5 miles. All of a sudden with this, you just press it in, and I got all the surface streets, it's so bizarre, it's so life-changing. But the thing that you don't buy stocks, Warren, for 10, 20, 50% normally. You like to buy stocks that over time double and triple. So you're fully saying that this $700 billion company is going to be $1.3 trillion. Then it's going to be $2 trillion. Then it could, right? It's 700. Okay, today.
You're saying it. I'm hearing.
Okay, but
Joe,
you're not worried about the law of large numbers because it's the most valuable company in the world right now at something like 720 billion. So you have no problem thinking that it's going to be the first company to go over $1 trillion in market cap. And I mean, sooner or later it's got to happen, obviously.
I won't make any prediction on that, Joe, but what I do know is when I take a dozen kids, as I do on Sundays, out to Dairy Queen, they're all holding their Apple, and they barely can talk to me except if I'm ordering some ice cream or something like that. And then I ask them how they live their lives, and the stickiness really is something. I mean, they do build their lives around it, just like you were describing. And the interesting thing is when they come in to get a new one, they're going to overwhelmingly get the same product. I mean, they have their photos on it. I mean, yeah, I know you can make some shifts and all that, but they love it.
Right, but my point, I mean, you see what I mean about the law of large numbers. It will be $1 trillion company event. It's only got to go up 40% from where it is now. So, I mean, I don't think you'd buy it if you thought it was going to peak at 800 billion.
Well, or they could, Joe, which they bought in shares quite aggressively.
Buyback, yeah.
Yeah, so they could, you could have a lot fewer shares outstanding at some time and still do very well on a per share basis. They bought in about 4% of the company last year, and they've been pretty aggressive on that. So my guess is they've got about 5.25 billion shares out now, but my guess is that 10 years from now they'll have substantially fewer.
Let me ask you a question. What would you put a bet on? Which company goes to $1 trillion first, Apple or Berkshire Hathaway?
Oh, I bet on Apple just because they've got a stronger position. And if Tim wants to swap it even up, I've got an 800 number for him.
I can't believe you're poor.
While we're on the subject,
go
ahead, Joe.
No, I was just thinking that one of your guys, you wouldn't say which one, I mean, did you really have to do that, Warren? I mean, what'd you say he had like? Well, yeah, I've built up quite a position. I've got, what did he have, Becky? How much did he have? Like 10
million shares. 10 million shares.
Yeah, I like it. I mean, I love it. I've got 10 million shares. And you go, yeah, I like it too. I got 133. I mean, that's cold, Warren. To just, you know what I mean? I mean, it was his idea. It's his idea. And then he had 10 and thought he was feeling good about himself. And you bought another 123 million on top of him? Seriously?
He gets to go first, Joe.
He was feeling good. Yep, I'm a big
feel
investor.
good about Warren.
Yeah.
Look, if Warren Buffett takes your ideas and follows you,
Right.
man, I think that would make you feel pretty good
That's
walking
true.
around with that. Right. All right, let's talk about another thing that you've been buying a lot of, and that is the airlines. We just found out, at least at the end of the year, how much you owned in each of them, and they were pretty significant stakes for the four majors. That would be
Right.
American, Delta, United Continental, and Southwest. At the end of the year, we were reporting that you had stakes of about 7 to 8.5% for some of these airlines. Where are you now?
It's about the same. They may have been tweaked just a shade. There again, one of the fellows in the office has essentially one of those positions. While he was building that position, he owned a couple of the others just because he wanted to get the money invested, and then he was going to shift over. So, but one of them has he has the American Airlines position, and I have the other three. Those positions, as you mentioned, we're fairly close to 10%. We don't want to go over 10% virtually on any stock. It complicates life for us. We do it occasionally, but it's a big decision to make whether to go over 10%.
Why does it complicate it for people who aren't familiar with the rules on what you can and can't do once you go over 10%?
Once you go over 10%, you become subject to what they call the short swing rule. So if you buy and sell a stock that you have over 10% of in 6 months, you actually have to give any profit to the company. Actually, if you sell and then buy, or buy and then sell, and they take the lowest purchase price and they take the highest selling price, it's been on the books a long time, and it can complicate things. Plus, you have to publish what you do within 2 days or so after you do it, which is not the case when you're below 10% when you report quarterly. So we don't go over 10% very often. And with the airlines, all four of the ones you named are repurchasing their shares. Now, at Wells Fargo, we went over 10% simply because the company repurchased its shares. We didn't buy any stock.
Well, you couldn't. For a financial company, you're not allowed to buy over 10%. Right?
Not unless you want to become a bank holding company. Yeah.
Right.
There's more laws on that. In any event, on the airlines, if we own 9%, we might find we were 9.5 or something like that because of repurchases. So we will stay under 10 in all probability, and that's where we are now. And like I say, one fellow owns the American, and I own the other three.
All right, let me read a couple of things back to you. In the past, you've said things like, I have an 800 number that I can call if I get the urge to buy an airline stock. My name is Warren, and I'm an airaholic, and then they talk me down. You also said that if a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville Wright. He would have saved his progeny money.
That's not true. He just saved him a lot of money. If you look at the last 30 years, you can look it up on the internet, I think there have been almost 100 airline bankruptcies. I mean, that is a lot. So it's true that the airlines had a bad first century. I mean, they're kind of like the Chicago Cubs. You know, everybody has a bad century now and then. and they got that century out of the way, I hope. But it's been a disaster for capital. I mean, it's got glamour to it. So you can always get guys to put some money up for an airline. And you can go to the internet and look at 100 of them that failed. And all of them now that are operating, you know, with the exception Southwest. I mean, they've been through bankruptcy, and I bought into one called U.S. Air. That was my previous investment in the late 1980s. Ed Colandi, who was the CEO, came out here. We had dinner at Gratz, and I gave him $358 million, and it disappeared almost before we finished dinner. I mean, the airline, U.S. Air had some favored routes, but Southwest was coming at them over time. And I tried to sell that stock at 50 cents on the dollar. It was a preferred stock. Fortunately, I wasn't able to do it, and then they had this blip. So we actually made quite a bit of money. I mean, we're 1 for 1 on airlines, actually, but not because we were smart. And then it went bankrupt twice afterwards, U.S. Air did. It's part of American Air now.
So why in the world do you buy back in now? If you are so sure that this was a horrible business, what's changed?
It's a very tough business because it's got the marginal cost of a seat is practically nothing. You have these huge fixed costs, and yet more person on, there's virtually no cost to it. So you're very tempted to sell that last seat too cheap. And if you sell the last seat too cheap, it becomes the first seat in a way. So it has this dynamic to it. And unless the airlines operate in the well over 80% capacity, what kills you is when they really have too many airplanes around. I mean, they do what anybody else does. If they got too many airplanes around, they get down to marginal cost, and marginal cost cause you to go broke over time in the airline business. The hope is that they will keep orders in reasonable relationship to potential demand. And lately they've been operating in the 80s now for a while, but it's a business you can always mess up.
You know, Charlie Munger was your partner,
Yeah.
your vice chairman of Berkshire Hathaway, was speaking at the Daily Journal meeting just a couple of weeks ago. And he talked about how you guys are in the airlines at this point, and then said, you know, I just went on and bought a ticket to Europe for $400 or $500, and I thought, what are we doing in this business? Was
Exactly.
Charlie on board with this decision?
Well, Charlie's generally goes along with me. I mean, he may say, well, this is, well, you know, I've never heard you come up with a worse idea, Warren, or something like that. But when Charlie says that to me, I know he's going along with me. So we get along very well. You know, he's okay with both these decisions. But as he would say, and correctly, it's not like the old days. But I've been hearing that a long time, and it's true.
Joe?
I thought if you're going to go to break, I was just thinking about the irony of this. So he loves Apple and doesn't own an iPhone, doesn't know anything about it, and he loves airlines, but hasn't been on a commercial flight since the Wright brothers, I don't think. You know absolutely nothing about
You're giving away my secrets.
Huh? What? When's the last time you were on a commercial flight, Buffett? Tell me.
Well, we'll save that for after the show.
Fair to say it's been over 30 years.
My family brings up the same thing to me, so I've been hearing this before.
Was the in-flight movie that just released Casablanca?
Actually, it was Birth of a Nation.
All right. I just thought about that you don't need, obviously, to use these things to have an investment opinion, but it's amazing. It's amazing. It's very interesting today, Warren. I'm enjoying this. I haven't left, and I'm going to stay here. I'm all alone.
Yeah. Well, you got to realize I started in textiles and department stores, so some of these things look good to me just on a comparative basis.
Yeah, right.
You know, Warren, it does occur to me, though, if you're building up such a significant stake in all the major players, is that anything that's like monopolistic behavior? Is there any concern to think that you would say something to the airlines to make sure that they're not competing on prices quite the same? What would keep somebody from worrying about that?
Yeah, I've never met the CEOs of any of the four airlines. I may have met one down at the Texas Business Hall of Fame thing to shake his hand. I mean, Herb Kelleher was down there for sure, but no, I have no communication with them. And index funds own a significant percentage of each one. And we'll see how it turns out. I mean, if the orders that they have now would not look excessive. I mean, they usually take options and they can delay deliveries and so on. But it can be brutal. And I mean, you've got lower cost airlines. You've got startups that can come at them, and historically, the pricing has been a very tough game. I do like the fact that they used lots of money to repurchase shares. Most of them had these huge tax carry forwards too. So they had a lot of cash coming in for a while. They've used up the carry forwards in general, but the idea that you're buying something because it has a huge tax loss carry forward is not the best signal in the world. It's getting into a wonderful business. But they bought in a lot of stock. I like that. And we'll see how they do. We bought them at lower prices, and we're not buying them now. And I don't want anybody to run out and buy airlines.
But you're a passive investor.
Oh, yeah, totally.
Okay. Folks, we will have much more from our special guest, Warren Buffett, when we come back after a very quick break. Welcome back to Squawk Box, everybody. We are in Omaha, Nebraska this morning with Berkshire Hathaway's chairman and CEO, Warren Buffett. And Warren, thank you again for taking the time to walk through a lot of these issues with us. We have some questions from viewers, and I'd like to start with one right now. This comes from Michael Kahn, who wrote in, I believe this came in on Twitter. He says, have there been any stocks you purchased that you changed your mind about and sold before they could even show up on a 13F?
Well, that's probably happened sometime, but I don't remember.
Off the top of your head?
No. That would be quite unusual, and of course it could be that it'd be one of the other two guys in the office might have done that, but I don't really remember that happening with any of us.
The reason I ask that question just now is because Dow Chemical preferred shares, they called the preferred shares on December 30th.
Right.
And from what I read, it said that it should have translated into about 6% of the shares outstanding of the company.
72 million shares, yeah.
I did not notice Dow Chemical on the 13F in this most recent filing.
We timed our sales so that once it got above the conversion price, we timed our sales, or tried to time them, because 72 million shares would be a lot of shares to get. And we did not want to own the common stock. We don't own any common stocks of any chemical companies. So. And as the stock went higher, we sold it more aggressively because we wanted to get 72 million shares done by the day, which was becoming more probable all the time that they would call it. And they called it exactly when we thought they'd call it. And I think our last shares were sold the day before, the day after, the same day. I mean, we timed it to be out of 72 million shares when we received those shares. And
I was going to say, so you didn't sell 72 million shares on December 30th
no, we
and 31st.
We didn't want to be in that position.
But you had been timing those shares all along.
Exactly. When it got above it, and it became, you were in a very strong market, and as Dow kept moving up, we would get more aggressive, and so toward the end we might have been selling a couple million shares a day when it got up to 56 or some price like that. That we were hoping to get out of the common by the time that they handed us all the common. And like I say, it worked out to the day. We were kind of lucky on that. I mean, we could have ended up with 10 million shares, but we were going to quit obviously when we got to the amount that was going to be handed to us.
Why don't you like Dow or the other chemical shares?
Well, we've never owned chemical shares. We own a especially chemical company at Lubrizol, but I can't recall a chemical common stock we owned. We bought the preferred stock of Dow, I mean, because we wanted a preferred position, and we held it. It was kind of interesting. We bought that stock in July of 2008, the preferred, and Dow was going to acquire Roman Haas, and they needed some money for it. And then the world fell apart in the fall, and Dow wanted to get out of the contract. They sued Roman Haas to get out of the contract, but it was held that they had to stick with it. So we closed the deal to buy the preferred stock in April of 2009, by which time the market had totally disintegrated. So at the time we closed that, we bought $3 billion worth. It probably wasn't worth tops more than 60 cents on the dollar. So we showed up with $3 billion for something that was worth about $1.8 billion maybe at the time, which is one reason people offer us deals. They know we'll be around at the closing. We showed up for the Wrigley closing too with the Mars family. That was on October 4th or something. But during that whole period, we had these commitments, and that kept me from doing some other things we might have done at that time. The fact that we had this $3 billion going out the door.
What did you ultimately end up making on
Well, we ended up making
shares?
about $1 billion, plus we had about 8.5%. Well, we had an 8.5% coupon on it for those years.
So you made $1 billion even before the preferred dividend that was paid throughout that time.
Yeah, we had $1 billion of capital gain, very roughly, and then we had $255 million a year of dividends during the time that we owned it.
Wow. Okay. I have a few other questions from viewers that I'd like to get to. And Joe, by the way, jump in if you want to as well. But in the meantime, why don't we ask a question that came from Curtis Carson. He says, how many suits do you have in your closet at home? I bet my wife fewer than 5, most over 10 years old.
Well, he would be right, except for the fact that I met a woman in Dalian, China, many years ago, Madam Lee, and I arrived at this hotel in Dalian at about 11 in the morning, and immediately 2 guys jumped into the room. A couple minutes later, I thought, what's going on? They started sticking tape measures around me and everything, and then they showed me a book with a whole bunch of samples and said, pick out a suit. Madam Lee wants to give it to you. And I never heard of Madam Lee, so I picked out one. They said, pick out another. And then I met Madam Lee, and she had started with a sewing machine 15 years earlier, and she employed, or more than that, and she employed 15,000 people, and she was a marvelous woman. So she just started sending me suits. I was thinking of opening up a men's clothing store for a while, but everybody'd have to be my size. So I literally I have probably close to 20, but they were all made by Madam Lee for me, and I'm very grateful to her. She's come to the annual meeting once or twice and brought her family, and she made Charlie a suit. She made Bill Gates a suit. I think Walter Scott.
Because you guys can't afford any of your own suits.
Well, not if we don't have to buy them.
Hey, Joe had a question here as well. Joe?
Yeah, the old expression, Warren, that if you have money, a lot of times you can make money. So back during the financial crisis, when people would love to have Berkshire sort of as a I don't know, an endorsement, or at least if you invest in it, you don't think they're going out of business. So you don't even have to like a chemical company, do you? I mean, if they're going to give you 10%, you just, at that point, all you think about is that they're going to be able to make good on those dividend payments. You don't have to like the financial, or you don't have to like the prospects for growth at that company, do you? I mean, anyone in a 2% world, if they can get 10% that they know they're going to get, it's like a no-brainer for you, isn't it?
Well, it's a fixed income decision, so you have to like. I mean, it's a credit decision more than an equity position. But the equity part, the equity part enters in. But you're making first of all a credit decision, which is what I made back in 2008 on Dow Chemical, and I made it on U.S. Air back in the late 80s, and it looked like I was very, very, very. They passed the dividend while we owned it. Fortunately, we had a clause in the U.S. Air Preferred where any dividends they didn't pay us compounded at a pretty good rate.
I mean, that's unbelievable. Other people can't get that kind of deal, obviously, and I guess, I mean.
Oh, they
go ahead.
They could have had my U.S. Air deal at 50 cents on the dollar not very long after I made it.
That's true. But some of the, I mean, and you double your money in 7 years. You don't need, all you need is a credit decision at 10%. You know what I mean?
Well, I haven't gotten 10%. We got 8.5 on the Dow.
What'd you get in Goldman or GE? What about Goldman and GE? I thought you got almost 10 on those, didn't you?
Yeah, we got 10 on Goldman and GE. We got some warrants there. But I will tell you, in late September of 2008, I don't think there were any other buyers around for it.
There weren't. That's true. But what if the world ended? You know, we'd all be. I mean, you might as well have done it. You know, either the world doesn't end and you're fine, or the world does end and then we're all screwed, right?
Yeah, what's the difference between, if the world's going to end, what's the difference between dying broke or dying 100 billion in debt?
Right. I heard it only can end once, though. That's something to keep in mind when you're investing in the stock market. You know what I mean? It's not going to, if it ends more than once, I'm not thinking about it right.
Yeah.
Walking Dead, that's
I'm
the
with
case.
you.
Yeah, right. Walking Dead.
Okay, right. Joe, we're going to continue this conversation in just a moment. And folks, when we come back, don't forget, we have much more to talk about with Warren Buffett. We've got today's top stories. We still haven't talked Unilever. We haven't talked Donald Trump and politics. Stick around. You can still get your last-minute questions in with the hashtag AskWarren. Squawk Box will be right back.
Becky is in Omaha, Nebraska this morning, speaking with the billionaire investor and Berkshire Hathaway chairman. He's a lot more than just those two things, Becky. He's funny. Yeah. He's witty. He's a little bit wild at times. I think you can probably confirm that. Warren Buffett CEO is a CEO. You know, this year, Warren, I was watching Creighton the other day, and I was hoping Creighton was going to win. They got a pretty good team, but I can't. These brackets, I told Becky, I may not even do them this year. We're going to get to the futures, but
Joe,
it's so hard. I don't know who's good. Kansas. I don't know.
Yeah, it's a season with no standout. Creighton started very fast, as you know, but we are going to announce again, probably the next week or so, we'll send it out to our managers. We're going to have the same contest among our employees that we had last year. And,
I love that.
And if they manage to make it, if they can get to the Sweet 16, if there's only one of them, whoever it is, he or she gets $1 million a year for the rest of their life. Now, we also have a prize of $100,000 for whoever gets the furthest. And last year, we had two fellows that tied. One of them knew a lot about basketball. The other didn't know anything about basketball. But they each got $50,000 out of it. And we're going to do the same thing for Berkshire employees this year. We had 85,000 entries last year, but I'll bet we go over 100,000 this year.
That's so fun. That's so great too. And I, you know, getting all 16 of the 16, it's like, please. I've tried. It's like if you get 10 or 12, you're doing pretty well.
Yeah, but it's not impossible.
I know.
And somebody's going to win. Somebody's going to win 100,000, or they'll divide it up. And actually, some of our individual companies, then last year they joined in with a tournament of their own. So I mean, it really caught fire. And what's particular fun is you can go to this website we have, and you can see after each game how many are left and how many have gone for in the next game coming up, gone for Team A or Team B, and we have a good time.
It is good. Gonzaga now lost, and you know I I like Jesuit schools like you and Xavier. We lost Edmund Sumner. He was so good, and he got torn ACL. I mean that killed me. And then you know I was going to start watching Cincinnati. Then they lost yesterday to Central Florida. It's hard. It's hard, Warren. Anyway,
I'll tell you what we'll do.
Okay.
Joe, send me a ballot. And I'll have one of the people put it in under their name. I mean, you could be. You can get in this
Last
game.
year he offered to let you be in it, and you didn't send it in.
You know why?
Remember?
Because Warren is very smart, and you know, the side of the trade that he takes, I want to be him. I'll give people money if they get them all right. That's like selling calls or something. He's always on the right side of these trades. No one's gonna do it. No one's. He's safe. It's like those people that insure the hole-in-ones. You know what I mean? I'd like to be the insurer. I don't want to be the person swinging. Anyway, we'll get back to this.
That's usually a good idea.
Yeah, exactly. I like to be the house. Let's check on the markets.
The house is where the
the house. You know, I'm going to see. I thought the Dow might turn up because you're going to juice Apple today. There's no doubt about it, Warren. And I thought the Dow might turn up. But Apple, I mean, who wouldn't buy Apple after hearing that type of financial outlay that the greatest investor in the world.
I want to emphasize.
Go ahead.
I want to emphasize we have not bought it at this price. I mean, we quit buying when the earnings came out. So if I were buying now, I wouldn't be talking about it for one thing. You know, we're certainly not selling either. But
Yeah,
I wouldn't be talking about it. But we're not. I don't want anybody to think we are buying it at this price.
And you know now, and your IBM stock, that call is looking much better at this point too. And I'm sure we'll talk about that, Becky, a little bit more. You can. We'll probably have a whole segment on IBM, but and that, you know, $172 billion, not $720 billion. So that, who knows where that could run if they get it going there. Anyway, back to you.
You know what, Joe? Ask about IBM right now because we have so much stuff. I'm afraid I don't want to miss anything. But if you have a specific question on IBM, why don't you jump right in on it right now? You're right. Wonder, that is a much higher price than where we bought it.
Yeah. What do you attribute that to? What has started? Is it been the cloud part of the business has gotten to be a larger part of the results at this point? So that some of these initiatives are starting to bear fruit. Warren, what do you think happened?
Yeah, Joe, the whole market has moved so much, to start with. And they increased the dividend. I think there's been some more interest in dividend stocks, and they increased it here recently. But I've got no information for you, yeah. IBM, except those two factors. But a lot of stocks, they really moved in the last few months.
Yeah, they certainly have. I guess that'd be a good segue to lead into President Trump, maybe, Beck, because you can attribute it to a lot of different things. I have people every day come in here that said the market was going to go down 5,000 points if he got elected, and they're all like, "You ought to see them dance now," explaining this war. And they're it's the equinox or something. I mean, it's the witches. They come up with all kinds of stuff to attribute why the market's up. They'll never say that maybe some of these policies could be pro-growth, but some of them are pro-growth. You must like some of them.
Last year at our annual meeting, and it was clear I was for Hillary, but I got asked a question about the market based on who got elected, and that does not. And I said America's going to do fine in terms of economically under either candidate as president. And people who mix their politics up with their investment activities, I don't think that makes sense. I've watched it all my life, and obviously, probably half the time of my adult life, I've had a president other than the one I voted for, but that has never taken me out of stocks. I mean, the American economy, we're up to number 45 or so, and we've done awfully well. If you mix your politics with your investment decisions, you're making a big mistake.
Although in terms of
Charlie Munger.
Oh, sorry, Beth.
Go ahead.
Just one last thing. You talk about how great democracy in this country is and the dynamism. And I have seen people, in the Journal op-ed or wherever, just people that say that democracy is ending. They look at this election and they say, wow, this is like the way it happened. Another orderly transition of power, and it was the way that it was done. It brought tears to their eyes in terms of this is still this is a prime example of how well things work and that democracy is alive and well, right?
Yeah, Joe. In 1951, I proposed to my wife, and my father-in-law was the most conservative guy in Nebraska, except maybe for my dad. My father-in-law said, "I want to have a talk with you." So I went over to his house to have a talk, and he sat there and he said, "Warren," he says, "I just want to absolve you from any worries. You're going to fail. And the reason you're going to fail, my daughter may starve to death, and you're going to fail, but I'm not going to blame you because it's because the Democrats are in, and they're all communists." And I listened to this thing for 3 hours, and I almost withdrew my proposal at the end. But I have seen people make economic decisions based on their political feelings, and it is not the way to do it.
Well, now, Warren, if Bernie Sanders got elected, I might make a few investment decisions. I'm sorry, but that's just me.
Yeah. I understand. Well, all my friends feel that way on one side or the other. But I grew up in a household where, when Roosevelt got elected for the third term, my dad said, there'll never be another election. We couldn't have dessert at our house if you were a kid unless you said something nasty about Roosevelt. But I bought that stock in 1942 when Roosevelt was president, and it worked out pretty well.
Charlie Munger made some comments also at the Daily Journal annual meeting just a few weeks ago, Warren, and he said that, look, he's mellowed on Donald Trump because he had some things that were not so nice to say about him before. He also said, look, not everything he's doing I disagree with. He's in favor of some of the things he said about Social Security and some of the other moves he's made. Have you mellowed as well? Well,
I would say that I would agree with Charlie on that in terms of the entitlements and Social Security. And I certainly, you can't help but feel if you're in business, everybody, there are a lot of regulations that I think probably have gone too far. So I will judge President Trump after 4 years based, number one, on how safe the country has been kept. I mean, that is the number one job of the chief executive of the United States. And that's not an easy job. And I'm not thinking of random killings or anything like that. I'm thinking of weapons of mass destruction. I mean, that's my number one worry, and that's the number one test I have. Secondly, I'll judge them to a degree, although they have less control over this. Well, they need a little luck on weapons of mass destruction too, but how the economy does overall. And then third, I'll judge them on how, if the economy does well, which I expect it to do, how wide the participation in a better economy extends. And those are the three primary tests I would have applied to Hillary Clinton or to Donald Trump. Meaning that if he passes on all three of those, you would consider voting for him in 4 years? Well, it depends who he's running against. I would say it'd be unlikely, but those are the three tests. I mean, those would have been my tests for Hillary Clinton. I think being president of the United States is the most important job in the world. It's not all powerful, and you need luck. But we've had weapons of mass destruction. Kennedy got us through the Cuban Missile Crisis, and somebody else might not have. And when you look at North Korea, trying to get an ICBM that can hit the West Coast and with warheads and everything, I mean, it is very, very, very important that you have a president for whom that's the number one priority too. And I actually think that with both Hillary Clinton and Donald Trump, they had an understanding of that. And if that's number one, and I think the odds are good, as I said last year at the annual meeting, that we'll have prosperity in any 4-year period. It's not a cinch. I mean, there are certain times when the economy has hiccups, but the odds are pretty good that any president has a reasonably good economy, and then I would like to see more people share in that good economy. All right, let's go through this one by one. In terms of trying to keep us safe, part of that must be appointments like Secretary of State. What do you think about Rex Tillerson in that position? Well, I don't know any of the appointments well, but I certainly think Rex Tillerson makes a lot of sense. I mean, you've got an absolutely outstanding person. And incidentally, I would say this too, because you get a lot of this in politics. Rex Tillerson is going to be working for the United States in that job. I mean, people that get all upset because he was with ExxonMobil or something, or because he's got a fair amount of money. I've seen a lot of people enter high levels of public service, and I think the great majority of them take it very seriously that their employer is the United States. And so I don't worry at all about the fact that somebody comes from the oil industry or that they've got a lot of money or anything of the sort. I do think most people rise to the occasion to quite a degree. Not always, but to quite a degree. So I don't know. Tillerson, I sat next to him one time at dinner, but he'd be the kind of person I would choose.
There's also people like Wilbur Ross, Stephen Mnuchin, Gary Cohn, who are all in these cabinet level positions too.
They're Wall Street guys. They're smart guys. And again, I would say that those people, none of whom I know well, but I know of them and I know people who know them. And I would say that they will take very seriously the fact that they are in public service. I mean, you may run into an exception every now and then. Spiro Agnew didn't come through too well, or a few in the past. But I think people take it seriously.
In terms of judging the economy, a lot of that's going to be done based on, we've seen the stock market run, as Joe brought up to this point. The next thing people are waiting to see what happens is tax reform. Before that happens, they're going to be looking at Obamacare for a repeal of that. All of these things will weigh on the economy. What's your overall take of the direction that we are headed right now?
I think, just on a probability basis, not specific to actually to any given administration, I think the odds are very high that any administration ends up better 4 years, with the economy better 4 years later than at present. But I would say that. Absolutely.
But what about the specifics of what have been proposed in terms of potential border adjustment taxes, in terms of immigration policies, in terms of regulation rollbacks, all of these things?
Yeah, I would still say I think the economy will be better off 4 years from now, even though I disagree with some of the specific policies. But I disagree with the policies of most administrations, of some policies. Border adjustment tax, I mean, it's an import tax, and an import tax is a sales tax. You're looking, we're at the Nebraska Furniture Mart. The store, it's in several buildings, does over $400 million a year. 75% of what you see is imported. I mean, if we pay an import tax on it, our customers are going to pay for it. It's a sales tax, and it's a sales tax in this case on items that are not yachts or anything like that. They're things that the ordinary person buys. So it would be a big sales tax. I think the president said initially that it was maybe too confusing or too complicated or something of the sort. My guess is that the Republicans, you don't get a shot like this where you control both houses in the presidency too often. They'll want to do things. I mean, McConnell will want to do things, and Ryan will want to do things. And my guess is that they will find doing something really comprehensive will be too difficult, and they'll want to get something done. You remember Russell Long by any chance?
Well, I know the building, the Long building in Congress.
Russell Long was Huey Long's son, and he was head of the finance committee. He was a senator. He actually owned Berkshire Hathaway stock, and I knew him just a little bit. He's the guy that coined that line, don't tax you, don't tax me, tax that fellow behind the tree. And if you're going to be revenue neutral, without the craziest dynamic scoring in the world, if you're going to be revenue neutral, it's going to get very, very tough. You'll have everybody in there saying tax the fellow behind the tree. And I think they will end up going for something not as dramatic as they might even like to do, because they simply don't want to spend the time and the political capital getting it done. But people realize if you control the whole place, you better get your stuff done at that time. And they look at the first term of the Obama administration. And you use up capital and use up time, and pretty soon they're thinking about the midterm elections and everything. So I just have a feeling when the Treasury Secretary says we'll try and have this by August or something, you're not going to get a really 1986 type overhaul or a 1954 type overhaul or a 1969 type overhaul in that kind of a time period.
Meaning you think something gets passed with lower rates, but not a border adjustment tax or something that we haven't tried in the past?
I don't think it's likely to get terribly complex, because I think as soon as you try and make it revenue neutral and you change one big segment, you will have every lobbyist in the world in there who says that isn't reform. My idea is reform, but not your idea. So that's just, who knows? I mean, you've got some master legislators and McConnell and Ryan that will be handling things so as to get as much as possible of what they would like through. But I think if you're trying for speed and you're trying for complexity, I think complexity will give way to speed. But that's, I don't know any more about this than your viewers.
You know, you mentioned that the border adjustment tax would be something that's a tax on consumers. I can certainly see that happening. But you also have American manufacturers who say, we're not competing on a level playing field. We're the only one of 35 OECD nations that doesn't have some sort of a border adjustment, some sort of a VAT or something along those lines. And as a result, it's hurting us, and we are not able to create jobs here as quickly. And that has been an issue that's been very important to the president. Is there another way around that?
Well, I wrote an article for Fortune a long time ago on import certificates. It's too long to describe here. But there are various approaches, and I actually have one I kind of like, but it would take a long time to explain. But I understand there's an article today by Marty Feldstein, I may be wrong on that, about how the dollar would adjust upward enough so that you really would be buying these things cheaper.
That's the idea, that in theory over time the dollar would adjust, but it's never been tried.
No,
so
I would not bet on that. For one thing, that kills exports. Free trade is wonderful for the world and for the United States. But its benefits are diffused among 320 million people. You buy your bananas cheaper because we don't try and produce them in the United States. But the penalties from free trade are terrible to specific industries. And as an investor, I can make a dumb decision on owning a shoe company, but if I own a good insurance company, I can diversify away the problems. If you're a 55-year-old steel worker, you can't diversify away your talents. I mean, you've had it. If steel or textiles or shoes become subject to total, it all moves offshore. So you want to have free trade, but you also have to take care of the people who, through no fault of their own, have spent their life learning one profession. And you can talk about retraining and all that, but it just isn't practical. And just take Berkshire Hathaway. We started with 2,000 employees in New Bedford, Mass, turning out textiles, and that business was doomed. And we had workers there who really they didn't have alternatives at age 50 or fair number of them just spoke Portuguese. They didn't have a chance. And a rich country that's prospering because of free trade, and as the world is prospering, should keep the free trade as much as possible, but they also should take care of the people that become the roadkill. You know, when industries
apparently
move.
That's been a problem. I mean, if you look at it, the election was a huge referendum on that.
Sure.
And both the Democrats and the Republicans are moving away from the idea of free trade, depending on the free trade that we've seen as free trade to this point.
Yeah.
Some of them will say this isn't free trade.
Yeah.
But what happens now?
You've got to take care of those people. And if I were somebody that had spent 25 years in shoes or textiles or you name it, and somebody came around to me and said, this is great for the world and it's great for those guys on the Forbes 400, but it's just too bad because you lose your job and that makes, we can buy our shoes a little cheaper, our underwear a little cheaper, our steel a little cheaper abroad. I would say that a rich society should figure out a way to take care of those people.
Okay. Warren, we're going to continue this conversation in just a moment. Our guest host again this morning is Warren Buffett, and he's been talking with us for an hour and a half at this point about things that have been going on. And Mr. Buffett, I can't believe it's been an hour and a half, and we have not gotten to a massive piece of news, and that would be the Unilever deal.
Right.
It was, I guess, just a little over a week ago that we first heard about this deal that Kraft Heinz and 3G would be putting together. Deal came out on Friday. Some news broke on it. Stocks for a lot of the other suitors that were not being considered, stocks like Mondelez and Campbell's dropped. Stocks of both Kraft Heinz and Unilever soared. By Monday, all of that had been kind of doused. What happened?
What happened? I can tell you what happened. Most of what I can tell you for sure, and then the others, a couple of things I have to draw inferences on. But Alex Baring, who's chairman of Kraft Heinz and part of the 3G operation with Georgie Paulo, and they and I agreed on making a friendly offer for Unilever if they were open to it. And Alex Baring went over to London, I don't know how long ago, maybe 4 weeks ago or whenever it would have been, and met with their CEO and had a conversation, and he brought up the idea of possibly making an offer late in the conversation, and he didn't get a yes, he didn't get a no, he got perfectly polite conversation, and the CEO actually, Greg Abel of Berkshire, known him 20 years ago. I mean, we had nothing but good reports about him. We felt fine about it. So Alex came back and said that he hadn't been thrown out. And so would we want to go ahead? So we went to see him again, and maybe 2 weeks later, and he had a letter that was an outline of a deal, which he thought if he got a neutral response he would give, but if he got a negative feeling, he would not. And he went over and felt he got a neutral response, and therefore gave the letter. Now, I might mention, it reminds me of that old story about the difference between a diplomat and a lady. I don't know whether you've ever heard that or not.
No.
But, well, if a diplomat says yes, he means maybe. If he says maybe, he means no. And if he says no, he's no diplomat. And if a lady says no, she means maybe. And if she says maybe, she means yes. And if she says yes, she's no lady. So he probably got a maybe and didn't know whether it was coming from the diplomat or essentially. I mean, that's what frequently people get. I don't work on acquisitions that way myself. I just go in and say, if you want me to make an offer, I'll make one. If you don't want me to make an offer, I won't make one. And I'll tell you a price if I do it. But there's usually much more of a mating dance than that. And so you get this, I'll take it to the board and all that. And you're dealing with different kinds of people. Some people are different cultures. They're more polite than others and so on. So Alex took it as being a maybe and gave this letter outlining a deal to Unilever, and it was said it would go to the board. Well, it became very apparent that Unilever did not want this offer based on, within a few days, press reports. For one thing, it leaked somehow on a Wednesday prior to the Friday one. And so on Saturday, I got, after that Friday, I got calls indicating that the offer was unwelcome. And I said, if it's unwelcome, and Georgie Paulo said the same thing. I mean, if it's unwelcome, there is no offer. I mean, it was only intended to be presented if there was a possibility. Now,
It was never intended as a hostile offer?
no, zero. And on the other hand, it may have been interpreted that way. And I can't argue about that. So if people say we don't like the price, that's usually a maybe. I mean, and
Is that what was said in this case?
well, that was said the first time. It wasn't said the second time because when I was called about it by a representative of Unilever on Saturday, I just said, I mean, if this is regarded as hostile or unfriendly, you don't have to worry about it. There isn't any offer. But if it's simply because you're negotiating, which people often do, when they take it to the board and they say, well, it's not enough money and all that, and then I'm not a negotiator myself, but the 3G people are more that way. So, but once the three of us learned that it was regarded as unfriendly, we had no intention of making one, and I think the Unilever people understand that now.
Is this a case you're saying of the Unilever CEO being exceedingly polite? And
Well,
that's
it can be polite. I mean, it can be differences in culture, even in the way people express themselves. I mean, Alex's second language is English. I mean, I've seen misunderstandings before, and that's one reason I like to do it the way I do it. I mean, when I went to Precision Cast and Mark Donegan, I just said, I will make an offer if you want me to, and if you don't want me to, forget it. I just said the same thing at BNSF. But that's not the way it's usually. There's usually more of a dance back and forth, and part of that's sort of what subtle law is. Now, the law is much different in the United States than in the UK.
Well,
but in any event, within an hour, we got across to them that we were not making a friendly offer, so we would go away.
That clears up a lot, because we had many questions that came in from viewers saying, is this the first time that you've done a hostile offer? Should we expect more to come?
No, we don't do hostile offers. Yeah, I don't have any. I don't think they're morally wrong or anything. I think there are plenty of companies that could use them shaking up, and sometimes it takes a hostile offer to do it. I mean, there are companies that deserve hostility, believe me, but Berkshire doesn't do it, and Unilever wasn't one anyway. But we don't do it.
So what happened in terms of Unilever? What attracted you to that company? What made you look at it and think this was
It's a great
good deal?
company, and I think they'll do fine things. I wish them the best.
With Unilever off the table, does that clear the way for a potential backup deal, something like a Mondelez or a Campbell's that
Well,
the
there-
market had anticipated as a potential?
Yeah, there isn't any backup deal. I mean, that was the only one that certainly I seriously thought about that made sense. So no, will there be another deal at Kraft Heinz someday? My guess is yes, but who knows when? I mean, there's no backup deal, and again, it would have to be friendly. And frankly, the prices in that deal make it very, very, very tough to make an intelligent deal.
Unilever was more undervalued than companies like Mondelez or
Yeah,
Campbell's?
it was. That's why Mondelez went down the next day and Unilever went up. But that's just my opinion. I mean, somebody else might have a different opinion on that. But Unilever looked more attractive by some, and it was larger. And we always like size.
Is that to say that you have, as a group, you and 3G have looked at all these other companies and are constantly assessing them?
Well, you always look at everything, yeah. But that doesn't mean you're going to do anything at all. But you can't help but be in the business and be aware of what various companies do, what they're selling for. I mean, that's a wonderful thing about investment. I mean, there's thousands of choices out there, and they change in price daily so that the relative attractiveness can change. But there's nothing in the works.
I had someone tell me recently that simply the activities of what Kraft Heinz and 3G and Berkshire's involvement with that, simply by them being there and watching 3G's operations, has put pressure on all the other food companies in that arena to make sure that they are shoring up their operations too, so they don't become an easy target. Does that make sense to you?
I think that's true. No, I think that when people see what the 3G management has accomplished, it may make shareholders of other companies somewhat unhappy. I mean, you've heard it expressed in a couple places. One thing I would emphasize about 3G, they are wonders at productivity. There's no question about that. But I've been on 20 boards. I have never seen anybody any better about marketing and product development and all of that. I mean, that is what we talk about at board meetings, and it's hours and hours. And I've been on other consumer goods company boards, and they're nothing like the intensity they bring. They don't just bring it to productivity. They bring it to new products. They bring it. I learn about what's going on in the marketing world a lot when I'm at the meetings of Kraft Heinz, because it's their game.
I mean, that's interesting that you bring that up, because the detractors of 3G, those who've been on the other side of some of these issues, have said things like 3G is just a roll-up company. That's what they're good at. That's not your experience.
It's not true. Well, I mean, they built the biggest beer company in the world, starting with nothing. I was at the last meeting just a month ago. We spent hours and hours. I learned what's happening in different channels, and the online retailers versus the brick and mortar. They really understand their business. I mean, it's so much more of an informed discussion than I've heard at most board meetings in my life. It's night and day. And I might say that they've developed a new dessert, which I had 3 different helpings of. So they're working on the right thing as far as I'm concerned. Every aspect of management they excel in.
What's the dessert that has caught your fancy? What is this?
Well, it's. I don't know how much I'm supposed to talk about new developments, but it involves it's cheesecake. But I can't go beyond that. But I did have 3 helpings, and then I took 4 or 5 of them home as well.
So they've won your vote, at least.
170 calories each. I had 3. That's 510 calories. The best 510 calories I've had in a long time.
When did you start counting calories?
I don't count them. I find them interesting just in terms of evaluating the product.
But it's not something you're worried about on your own.
I don't pay any attention.
Okay, thought we had some new diet that was going on here.
No.
Warren, in terms of how much money you have in cash equivalents, the annual letter that you just wrote laid out $86 billion.
Yeah.
That is money that is piling up at this point.
I hate it.
Do you have an itchy trigger finger at this point?
No, you can't afford to have an itchy trigger finger. But well, in one sense, you can say I always have an itchy one, in the sense that I'm always looking for things to do. But it doesn't change my standards in terms of having But I'm always looking. If we only had the 20 billion we regarded as our minimum, I'd be looking because we could sell some things if I found something attractive enough to do.
But if you have 86 billion, if it doesn't change your standards, it certainly broadens your horizons. There are.
We can do something big.
Yeah.
And we'd love to do something big. But
Are you working on anything right now?
I'm always looking, but I would say that there's nothing close.
Nothing close.
I don't think so.
Okay. I want to go to a few questions from viewers. There was one that was sent in. Sorry, just jumping through. One sent in from Ken Malott. This is T13 control room if you guys want to follow along. It says, you only find out who's swimming naked when the tide goes out. Do you feel that there are many naked swimmers right now?
Well, it's not like during the internet boom or various real peaks. I've written a couple of times when I thought things were getting out of hand on the high side, and that's not now. Now, if interest rates change dramatically upward, then these valuations would come down, in my view. But I don't see the games being played on a big scale that you had in the late '60s or that you had around the internet time. You know, I don't see lots of just fallacies being being promoted or games being built on accounting tricks and that sort of thing.
Is it fair to say, though, you point to interest rates, is it fair to say that much has been built on the idea that interest rates are not going to necessarily rise rapidly or dramatically anytime soon?
Yeah, low interest rates push stocks up. You know, I mean, the 10-year bond is selling at 40 times earnings, and it's not going to grow. And if you can buy some business that earns high returns on equity and has even got mild growth prospects, you know, at much lower multiple of earnings, you are going to do better than buying 10-year bonds at 230 or 30-year bonds at 3 or something of the sort. And but that's been true for quite a while. I've been talking about it the whole time. I said people were idiots in 2008 to put their money in cash. I mean, it was the one thing that wasn't going to go anyplace. And interest rates are enormously important over time. And that's if bonds yield a whole lot more a year from now than they do now, stocks may well be lower.
You know, the interest rates, though, the Fed has been talking a tougher game this year than they had been before. The Federal Reserve meets again this month, or in March they've been meeting, and they could raise rates as quickly as then. Do you think that this is a position, we're getting into a position where the Fed could raise rates rapidly?
Well, I don't really know, but what I do know that when you've got Europe and Japan with the rates they have, and particularly Europe, I mean, that's if the spread gets, you've got to be thinking about the spread. You're not going to have 8% rates in the United States and 1% rates in Europe or something of the sort. So Europe is a big factor, and you know, you widen it out. The dollar gets stronger, that hurts export. I mean, there's a lot of consequences to everything. You never can do just one thing in economics. You always have to say, and then what? And if I were the Fed, I'd probably be saying, and then what, if I got too big a spread against Europe.
Right. Okay, we're going to continue this conversation in just a moment. Welcome back to Squawk Box, everybody. We are live in Omaha, Nebraska this morning with Warren Buffett. You all have been sending questions in, and we want to run through a bunch of these as quickly as we can. Warren, first of all, I had someone write in, Gary Gambino, folks in the control room, it's T26, says self-driving car technology continues to advance rapidly. How do you see it affecting Geico earnings?
Well, self-driving cars will be adopted if they're safer. If they're safer, there's less in the way of insurance costs. That brings down premium volume significantly. So if all the cars, if a safe autonomous car had been developed, then there's 260 million vehicles on the road, so it takes a time to break in. The average age is about 11 and a half years or something. But if the day comes when a significant portion of the cars on the road are autonomous, it will hurt Geico's business very significantly.
It sounds like you potentially see something like this happening sooner maybe than you had anticipated a few years ago. That's the case with me.
It's the last 1%, though, that's a problem. I mean, it's going to happen one way or another. But, you know, who knows? You had that situation in St. Louis a year ago, and if you were driving down the road and somebody took control of your car. Only one or two experiences like that can slow it down a lot, but it'll come. If I had to take the over and under 10 years from now on whether 10% of the cars on the road would be self-driving, I would take the under, but I could very easily be wrong. You've got very, very, very smart people, a lot of them, working on it. You've got the big auto. It's something that billions and billions and billions of dollars are being spent on, and brains are being involved in it. So it could easily come sooner than I think, but it will be negative for auto insurers.
Let's go to a question, T129 from Paul Howard. He says, what would you do to tackle the country's debt? Would you like the 50 or 100-year bond idea?
Well, I think that when rates have been where they've been the last 5 or 6 years, or even a little longer, selling very long bonds makes sense for the same reason I think it's dumb to buy them. I wouldn't buy a 50-year bond, in a million years at these rates. So if it's that dumb for me to buy it, it's probably pretty smart for the entity to sell them, if I'm right. So I would say that the Treasury, I would have been, there's a lot of considerations they have, but I would be shoving out long bonds. And of course, at Berkshire, you mentioned we had $80-some billion in very short stuff. I mean, everything we buy in the way of bonds is short.
It's short term. Okay, one more question. This was T70. The question is, what does he think of the Fannie and Freddie lawsuits and housing reform?
Well, I think that Freddie and Fannie were broke in September of 2008, and they were a big cause of what happened in that month. They were the first of the really big dominoes. I mean, Bear Stearns had been some months earlier, but those were huge dominoes, holdings of their paper around the world and everything else, and they were broke. And the people that encouraged policies that caused them to go broke deserve some responsibility for what happened subsequently. For various reasons, the government didn't want to take over 100% of it. For one thing, I think they'd have to show it on their balance sheet and all of that. So they came up with this conservatorship. They have changed the game when they went into this sweep arrangement here, and they just did it overnight. They just said, we're just going to take all the money out so that there can be no recovery, essentially, for the Freddie and Fannie securities. That's getting tested in court, and you can argue that if you go all the way back, there wasn't any equity at all for those securities. The government made the equity by coming through with huge amounts of money, but the courts will decide it.
I want to revisit some of the stuff that we've talked to Warren about, because, he knows insurance in and out, through and through, and it's such a great business for a guy like Warren. We already talked about, some of the ways he can do things where it seems like he's going to be on the right side, like the dealer. It seems like he's just by definition going to be on that. And insurance is such a great thing, isn't it?
The house.
Warren? If it's done right, insurance, like you get a.
If it's done right.
If it's done right, you got.
Just do this now. Just jump in. Let's do this now.
You got, Warren, you got 1 year where we ran out of letters for the named hurricanes, you know what I mean? And so it's like, oh boy, this is for good. And then you're like going, you're like this, ooh, the premiums are going. And then the next 10 years, you got basically not a single category. So the way that it can be done is pretty amazing. But I hesitate to delve into this, but you have said in the past that you haven't seen catastrophic events increasing in terms of the insurance business, right? And year after year. Is that fair to say? It's been sort of static, or it's been predictable?
Well, it's not predictable, but it's been the frequency of Florida hurricanes, for example, has been quite low for the last 10 years or so compared to history. That's not been true in Asia. I mean, New Zealand had a quake a while back that would have been equivalent to, in relation to their population, probably 3 times or so what we've ever seen in the United States. But most of the cat covers do relate to the United States, you see. And Matthew came close last year to being a big one, but it's been remarkably benign in terms of Florida, Texas, the Southeast for quite a while. But that doesn't tell you anything about next year.
I know.
But the prices went to where we don't want to ride it. I mean, we did not feel like the house anymore, as you put it, when rates got to where they are now.
Right. The reason I'm bringing this up, I'm also thinking about, I mean, have you been paying off more in flooding, or do you know whether the increase of tornado damage has stayed relatively flat? Has it gone up? How about wildfires? How about the idea, the notion is that all these things are happening with this great frequency now. And I'm just wondering, is that true in terms of insurance? And I could understand how damages would go up because there's more people and they're populating the coast, and there's just more people around for tornadoes to hit. So I could see that. But do you know, is the incidence absolutely increasing as a show of that we're screwing things up?
Well, last year tornadoes were unusually frequent, and if you wrote comprehensive auto or you wrote homeowners in Texas, you probably lost a lot of money on that line. We have, I don't know, 25 auto dealerships or thereabouts in Texas, and we had losses that were, I think, 7 or 8 times the premium we paid, for example, on cars damaged at our auto dealerships through tornadoes. So Texas got hit hard. Well, a lot of places got hit hard. So what you've seen in the last few years is more tornadoes than you might expect, and fewer hurricanes. But who knows what's going to happen next year? You've seen, you actually had a big quake over in New Zealand not that long ago.
Yeah, quakes.
Nothing like we had a few years ago.
Yeah, I mean, we haven't quite started attributing quakes to increased CO2. That's coming, I'm sure. But no, I'm just trying to get a feel for whether. I'm trying to get a feel for whether I saw, one of the most vocal advocates of anthropogenic global warming, this Michael Mann gentleman, said we don't need to really measure things anymore because we can just see things, we can see the catastrophes happening, so that we don't need to actually look at any data. We know it's real because it's happening. And I don't know, I remember things happening when I was young too, so I don't know whether the frequency is higher or not.
Sure. No, I have not seen anything yet that would cause me to change the way we look at evaluating quakes, tornadoes,
floods,
hurricanes,
droughts,
by hemisphere.
Right.
Yeah.
More
now,
snow,
that may happen someday.
Less snow, more. It's
Yeah.
unbelievable. Okay. I'm not going to ask you anything else beyond that, because, I mean, there's nothing more important, obviously, than things like clean water and clean air and keeping chemicals. And the EPA has a lot of work to do with waste sites and all these things. I just don't know whether it's a slam dunk that we've changed the entire climate at this point. That's my only point.
Yeah, the only thing I've changed my view on is I now charge a higher rate for hole-in-one insurance when you're playing in the tournament. I mean, we have done that, but that's been the only major change in our underwriting policies, Joe.
When you're sarcastic, it doesn't work well. Warren.
Okay. I'll back off.
You're so safe. You're so safe. The only thing you're safer is if if it's a wedge, then you're even like a sandwich.
We've written a lot of hole-in-one insurance over the years.
Well, that's perfect for you. It is. That's like your perfect thing. That's like your.
It is.
You should. That's why for you to win that Final Four March thing, make it $1 billion. You've got it. No one's going to do it. Just make it even better. What do you got? Just make it more. You'll get more headlines. Make it $1 billion. Why?
I'd rather get more premium. Forget the headlines. I want more premium.
All right.
Hey, Warren, I want to give you a moment to follow up on
Sure.
what we had just ended talking about, Fannie Mae and Freddie Mac.
Oh, yeah, one point I'd like to make is that I think it's enormously important for the economy that we have readily available 30-year government guaranteed mortgages. I mean, I think this country will function better. Homeowners will borrow for less with a government guaranteed mortgage. I think the problem comes when you try to mix up the private sector with the government, because serving two masters is tough. And you had that board, the boards of Freddie and Fannie, with some government representatives. You had the Congress telling them what to do, and you had Wall Street telling them what to do. I think that's a bad model. But I do think it's important that we have a government guaranteed 30-year mortgage. I think that's good for our citizenry, and I think it's good for the economy.
But you don't think we need Fannie and Freddie to do it?
I don't think that. I don't think you need Fannie and Freddie at all to do it. I think you need a program that is government sponsored, and you may want to have private insurers have to take 2% of everything they do or something of the sort, just as a check on pricing and all that sort of thing. But basically, it's got to be the government.
Okay. Warren, I want to get back to the annual letter. And something that jumped out at me this year was a phrase that you put in that you don't hold stocks forever. You just wanted to make clear. There was a section, a small section that you put in, just said, look, people have said we own stocks forever. That is not the case. Why did you put that in this year?
Well, there's a section in the report, which has been there for 30-some years, saying that we won't sell a business just because we get offered a fancy price for it or anything. But if it ever has one of two things happen, either that it promises to lose cash forever, or we have major labor problems of some sort, we would consider selling. But I've gotten calls on businesses saying, I'll pay you way more than it's worth, and I say, I'm not interested. People had interpreted that. In fact, one of our directors had interpreted that as meaning it applied to stocks as well. Well, the truth is we keep selling stocks, and our favorite holding period is forever. I mean, it'd be nice to find stocks. I've owned Berkshire forever, I mean, for 52 years. So I followed it myself, and a lot of my families followed it. But we don't commit to owning anything, stocks forever. We do commit when a fellow sells me his business. I commit that we're going to keep it. We're not going to resell it to anybody. We're not a private equity firm. And if it's disappointing, we'll keep it unless it gets in those two categories. But that one section in what I call the ground rules had proved ambiguous, is proved by the fact that one of the directors actually mentioned it to me. So I just thought I better clear it up.
Should that lead us to think that you might be selling any of your ultra long-term holdings? If I think of Wells Fargo or Coca-Cola or American Express, stocks that have seemed like you've owned them for
We've
forever.
got no intention of selling those. On the other hand, let's say the world's greatest deal came up. I mean, there's no self-imposed ban on selling those. I've got no plan to sell them, but I just wanted to clear up that one point because it was the way I'd said it earlier wasn't clear.
Let me ask you a question. This is T20. Control, I'm going out of order on this. T20 comes from Chris, who writes in, what are your thoughts on the border adjustment tax? We've talked about that already, but he does want to know, was this a factor regarding your recent sale of Walmart? Maybe you could talk a little bit about the sale of Walmart and why you did that.
Well, Walmart's a fabulous company. And what Sam Walton and his successors did, I mean, that's one of the great stories of American business. I think retailing is too tough for me, just generally. We bought a department store in 1966, and I got my head handed to me. I've been in various things in retailing. We bought Tesco over in the UK, and it wasn't we. I bought Tesco over in the UK. I got my head handed to me. Retailing is very tough, and I think the online thing is very hard to figure out. Now we're sitting in a retailer we own that does very well. I mean, I think this particular business is relatively immune from the online business, although we do a lot of online business here. But this does very well, and I think it'll continue to do well. But I think Amazon in particular is someone that's it's an entity that's going to have everybody in their sights, and they've got delighted customers, and it's extraordinary what they've accomplished. And a lot of people they like the delivery. And that is a tough competitive force. Now Walmart's pushing forward online themselves, and they've got all kinds of strengths. But I just decided that I'd look for a little easier game.
A major investor I spoke with recently asked me this question. I'm not sure if it was supposed to be on the record or not, so I won't use the name. But this investor said that he or she had heard you recently making some comments about Amazon, where you were very complimentary of Amazon. As founder, Jeff Bezos said he's probably the best manager you've ever seen.
I think maybe he is. Yeah, I've said that. I mean, it's remarkable. I mean, here a guy, gets in a car with his wife to leaves Shaw and starts driving across. And he thinks, how am I going to take over the world? Maybe I'll sell books online. He is one terrific business person.
That investor then asked me, why don't you own shares of Amazon?
Well, that's a good question, and but I don't have a good answer. Obviously, I should have bought it long ago because I admired it long ago, but I didn't understand the power of the model as I went along, and the price always seemed to more than reflect the power of the model at that time. So it's one I miss big time.
Is it too late, or you just don't know?
I just don't know.
Yeah.
Retailing is tough for me to figure out. I mean, if you go back to when I was a kid, in every town, the guy that owned the big department store was king. I mean, whether it was Marshall Field or or Dayton or Hudson in Detroit or Frederick and Nelson, Seattle, or you name it, J.L. Brandeis in Omaha, the department store was king. And people said, what can happen to it? It's down there where the streetcar lines crossed, and the women took the streetcar to shop there, and they could see 500 spools of bread and 500 wedding dresses, and they couldn't see anything like that. It offered this incredible array of goods. And then somebody came along with the shopping center, and instead of making it vertical with all this display owned by one person, they spread it out, owned by many. And now comes the internet, and that's the ultimate variety of things that you can get to very easily. So people love variety, they love low prices and a whole bunch of things. So it just keeps evolving, and the great department stores, many of them have disappeared, and the rest are under pressure.
It's a business that has changed rapidly, and it reminds me of another business you're invested in, newspapers. The publisher used to be the king of the town as well. What's happened to newspapers?
Newspapers, there are only 2 papers in the United States that I think have an assured future because they have a successful internet model to go with their print model, and that's the Journal and the New York Times. And I'm not saying it'll even be easy for them, but they have developed an online presence that people will pay for. Now, the third that may do it, again, going back to Bezos, is the Washington Post, and he's improved dramatically their situation online, and so it's conceivable that their math works. But if you look at, there's 1,300 daily papers left in the United States. We've got 31 of them. There were 1,700 or 1,800 not that many years ago, and it was an incredible business when you were first in everything. I mean, you could tell people how their stocks closed. I learned how my stocks closed by looking at the paper. I learned who won football games or what the box scores was of baseball. I learned all kinds of things with the paper first, and now you've got an internet. And aside from the ones I've mentioned, 13 or 1,400 papers haven't figured out a way to make the digital model complement the print model in such a way as to guarantee the future. So circulation is going down significantly. Advertising, I mean, it used to be dozens and dozens of pages of help wanted ads. It basically disappeared, and no one has found the answer to that yet.
President Trump has looked at the media as a potential enemy. Steve Bannon has said they are the enemy.
Yeah.
You've had a long relationship with these newspapers that you read every morning. You've been invested in newspapers like the Washington Post and many other newspapers. What do you think about that?
Well, I think that every president I've known and every politician virtually I've known, one way or another doesn't like me. They just are smarter about how they handle it, maybe in terms of covering it, or maybe he's smarter taking them on. But in any event, the media is looking for things to write about, and they should. I mean, that's their job. But who wants somebody looking at everything you do with a critical eye? And the higher the office, the more they're going to look at it with a critical eye, the more airtime it's going to have and everything. So he expresses his feelings, but I would say that he is not unique in having those feelings among politicians.
Not at all. You know, you are not somebody who has embraced Twitter, although you do have a Twitter feed. How many times have you tweeted?
Well, I think there's 7 tweets up there, but I haven't done any of them. I have this friend that talked me into getting a Twitter feed, and she's put up a couple things. But the answer is I've never tweeted anything really myself.
Do you find yourself following, though, anything on Twitter? I mean, I know you don't have an iPhone, but I know you have an iPad, right?
I have an iPad. Somebody gave it to me, though.
Do you ever
No, well, I would say this. There's 2 things I was told in life many, many years ago that turned out to be terrific advice. One is to praise by name and criticize by category. Somebody told me that 40 years ago. And Tom Murphy, 40 years ago, said, Warren, you can always tell somebody to go to hell tomorrow. You haven't lost the option. Both of those pieces of advice have been very good. And I would say that both email and Twitter really can cause you to stray from that very easily. Because if you can just whack out something, it's very easy to tell somebody to go to hell in 10 seconds if you get mad at them. And the very act of having that available instead of writing a letter or doing something of the sort, I think has made a lot more things come out of the people shouldn't have said. I think they do better following my philosophy, but I think it's harder to do that if you can tweet something out in 5 seconds or go to email and say, do the same thing.
So how often do you think that guy's an asshole but not tell him?
Well, I've certainly thought that over the years. It hasn't always been guys either.
Did you just think that about me?
No, I think, for one thing, sometimes you really do feel differently the next day. And you haven't lost the option. You know, people have done things where you feel like, you know, exploding over it. And
How many times have you had to use your own advice?
a fair number of times. Yeah. For one thing, it's reinforcing in that you see that it works. Yeah. A lot of people have said things in emails or whatever that we stand and said. They didn't need to say them. You know, I mean, and they don't lose the option. You can tell them to go to hell tomorrow.
Is that a more important lesson in business or in life?
But it's very important both places. Now, you learn about that. I mean, I think, who was it, Kierkegaard that said life can only be understood backwards, but it must be lived forwards, basically. And you do learn about a lot of dumb things, including writing letters in the past, but now including tweeting and emails. I mean, your first impulse is not necessarily your best course of action.
Is that why you don't email and you don't tweet?
Well, it's probably just because I'm inept, but that is a good rule not to. But it's a good rule to follow. I mean, I would say that if you had a delay system on every email or tweet, and it couldn't go out for 2 hours, I don't think they all would go out that people send.
The trouble is we all still have our mouths that get us in trouble.
Yeah, definitely. I'm a walking example of that. No, it really is a mistake to give an instant reaction, you know, to everything that comes along, because you're going to have some things that are irritating for one reason or another. But people will tweet, and they'll send emails. And I sent, you know, the one email I sent in my life, you know, ended up in federal court.
Tell people about that. What was that email?
Well, what happened is that Jeff Rakes, a friend of mine from Nebraska, was in a top position at Microsoft, and in the 1990s, on my one email, he emailed and said, doesn't Microsoft meet all your tests for a wonderful business, and laid out some reasons, and I emailed him back as to why I didn't buy Microsoft. And I also threw in some comments on Nebraska football. Well, I guess the U.S. government decided this email that he'd sent me or I sent him had some meaning in terms of Microsoft's position in the economy. So one day in the Wall Street Journal, I see my email is posted for the world, and I thought, I didn't worry about what I said about Microsoft. I worried I said something negative about Nebraska football and would have to leave the state forever. Fortunately, I didn't.
Hey, Joe is somebody who shares your concern about Twitter, who tweets very rarely. And Joe, I know you want in here too.
I block. That's the best thing about it. You can block people very, very quickly. So in the past, Becky, whenever I wanted to use that word, I would say someone is a royal a-hole. And that's a company, and I can get away with.
I know, but he said tell people to go to hell, and the other phrase jumped in my head. And
well, it shows the problem of quick response.
Here's the deal. I have said ass, because isn't an ass a donkey? Isn't a donkey? So I can say ass.
It is.
And I say hole all the time. So.
I don't think we should pursue this too far,
if you're
Joe,
going to start, Becky, if you're going to go here, I would like to use that word all the time. If it's now a fair game, I'm going to just.
It's not fair game.
It may be in every sentence.
Do not take that as fair game. That was a mistake.
Do you want to illustrate it, Joe, with examples?
I thought he said the other. I thought he said the other. I thought I was repeating his words.
Well,
I was not.
Charlie and I have a code word we use when we see some guy that we really think is a jerk. Yeah. We will say to him, boy, you think like a CPA. And the guy kind of gets all pumped up. And of course, our code word is crooked, psychotic, and you could fill in the last.
So you
Can
don't
I
wanna be a
fill in the
CPA.
Can I fill in the A? I'm still
No,
in.
don't.
Royal Ahold.
Don't.
Royal. It was actually bought by Delta.
Thank you for harping on this.
Well, me and your husband, I looked over and we were
Is
both
that the
like,
only thing you wanted to jump in on? I thought you had something else.
no, I want to know. I want to start using it. If it's okay now, I want to because I need
We've lost our
it.
PG rating. We've lost.
No, I've used Becky.
CPA,
I've used that before. I've used that before. And I say Shih Tzu all the
my
time.
mistake.
I say Shih Tzu all the time, and I will
Okay.
continue to because
Never
that's a
mind.
dog.
Let me out of my embarrassing snafu. Let's go.
It wasn't a snafu.
Ask something else.
All right. Go ahead.
Ask something else.
Oh, ask something else. No. Okay. Have we exhausted
No,
the talk about the 10-year war?
This topic, yes.
No, you never answered me whether it's weird to see the bond market so well behaved when so many people are suddenly worried about reflation or deficit spending. We're not going to do anything with entitlements. We're going to increase military spending. We're going to spend $1 trillion on infrastructure. We're going to cut taxes across the board. Why do you think that the bond vigilantes, which is Becky's, that's the way she likes to say it. I like it too. But why do you think that it's so quiet, Warren?
It absolutely baffles me who buys a 30-year bond. I just don't understand it. And they sell a lot of them, so clearly there's somebody out there buying them. But the idea of committing your money, at roughly 3% for 30 years. Now, I think Austria sold some 50-year bond here, at below 2%. I just don't understand the. In Europe, there's certain inducements actually for the banks in terms of capital requirements to load up on governments, but it doesn't make any sense to me.
You just said that a 50 or 100-year U.S. Treasury might be a good idea for the Treasury to sell, but is that an indication that you would not be a buyer?
Absolutely. I would not be a buyer. Yeah.
You wouldn't necessarily recommend anybody else buy it either?
No. But, that's why I think the government should sell it. I think it's a bad buy.
Okay. Warren, we're going to continue this conversation. There's so much news we still haven't gotten to, one of those being Wells Fargo. We haven't gotten the chance to sit down and talk to you since everything happened with Wells Fargo. And we had some viewer emails that came in as well. I wanted to ask you one of them. This comes from Norm. And guys, this is T31. He says, to ask you, given your ownership of Wells Fargo, please explain your criticism of management, why it's been muted for Wells Fargo versus the Salomon Brothers incident.
Well, it might be muted under any circumstance. Well, with Solomon, the company was failing and might have been out of business the following week with huge repercussions for Wall Street. So that was a whole different thing. They asked me to come in. I was on the board. But with Wells Fargo, because they repurchase shares, we're actually owned slightly more than 10%. We have to be a passive investor there by law unless we want to become a bank holding company, which we don't want to become. So I might well have been just as passive anyway, but I can tell you that I had to be passive in any event. They made a huge mistake. The huge mistake was not necessarily the dumb incentive system. I mean, everybody comes up with, incentive systems are fine. Sometimes they incent the wrong things, and this certainly incented the wrong things. The problem was they didn't do something about it when they learned about it. I mean, it was the same thing as Solomon in that sense. And, I just keep preaching to our guys that if you see a problem, attack it immediately. It isn't going to get better. And a huge mistake was made at Wells, not in cooking up the incentive plans. Cross-selling is fine. I mean, you want to have incentives for people to do it, but you don't want to have it lead to crazy behavior, which it did. And the big mistake was when they found out about it, they didn't do anything about it. I think their fine was like 180 million or 185 million. I think they saw that wrongly as in the light of $5 billion fines that were put on for mortgage practices at some other bank, and $3 billion fines. So they saw the problem as sized by the size of the fine, and it wasn't at all. I mean, anytime you have people making up accounts and doing all the things they were doing, it isn't the size of the fine that measures the customer impact. It's and how your reputation will suffer. it's what you were doing, and it was wrong. And
The
they
fine came 5 years later after they'd been doing it for 5
right.
years.
And clearly they knew what was going on to some extent, and they didn't do anything about it. And I will say this: if the top guy doesn't do anything about it, the people down below. John Stump is a perfectly decent guy in my opinion. I'd have him as trustee of my will, and I wouldn't worry for a second. But somehow, when he saw the evidence, he didn't do something about it. Now, maybe he thought somebody else was going to do something about it. That part is similar to what happened at Solomon. I mean, John Goodfriend thought that he postponed calling up Jerry Corrigan, and that was late April. And on May 15th, another government bond offering came along, and the guy that was behaving badly behaved badly again, and now it was too late. And I think to some extent, when you get behind the 8 ball and you don't do it immediately, you keep thinking, well, maybe it'll go away, because if I come in now, they'll say, why didn't I come in 6 weeks ago or 6 months ago? Whatever it was, it's a terrible mistake when you see a problem not to attack it immediately. You know, it can be unpleasant, but I say get it right, get it out, get it right, get it fast, get it out, get it over. And I keep telling our managers that, and I'm sure something is being done wrong now with 367,000 employees at Berkshire, and I just hope I find out about it and do something about it.
What do you think of Tim Sloan, the new head at Wells Fargo?
I've had lunch with him once. I have lunch with him again in a week or two, and I think he's doing fine. And they made a big mistake, and they're correcting it. I don't think in terms of the earning power of the company 5 years from now, it's material, but that's.
Tim Sloan was there at the time. Did he have any involvement in any
Well,
of
not
this?
that I mean, what I would guess is that there's consumer banking, and it goes up a chain, and that
Sure.
that there's a person who's got a very responsible job ahead of consumer banking that should do something about it. But if that person doesn't, then the CEO has to do it.
So
And the board isn't going to know anything about it any more than you don't learn about that sort of thing at board level.
Right. Can we talk about Bank of America?
Sure.
That is another large holding. You
Right.
don't count it in your 15 biggest holdings because of the different way that it's structured.
Yeah,
with
we
the
own
warrant.
warrants there that come in through. Yeah.
So you talked about it in the annual report about when you might or might not go ahead and exercise those warrants. You want to lay it out for people who didn't read that deeply? in the
Yeah,
report?
we can use our $5 billion of preferred as the payment for the warrants, which are 700 million shares at $7.14. So we can have a cashless exchange. We're getting $300 million a year from owning the preferred. If we use that preferred to exercise the warrants, it would only make sense if the common we received paid us more than $300 million. And the magic figure on that is 44 cents. I have no idea whether they will pay that or not, but I just wanted to be clear in the annual report that that would cause us to exercise the warrants earlier than their normal time, which would be a day before expiration.
Right. You also used the annual letter this year to really lay into investment managers, hedge funds in particular, and people who think that they can get ahead by relying on experts when it comes to investing. There was a viewer email that came in, and the gentleman said, if you were looking at these issues, you talk about the know-nothing investors.
All you
a lot
have to
of
know is
times.
that America's going to do okay, yeah.
Well, the know-nothing investors, I think he may have taken a little umbrage to that. What is a know-nothing investor? What does that mean?
This person is not a professional. I'm a know-nothing doctor. I'm a know-nothing dentist. I'm a know-nothing obstetrician. I'm not in that business. And the idea that you're going to beat a game that you're not even necessarily trained for or spent your life at or anything like that. It's not saying the guy has a 0 IQ. You can have a 200 IQ, but not be involved in investments. I don't know why light switches go on. You know, I think I'm generally reasonably intelligent, but I still don't know. You know, I'm a know-nothing physicist.
But your point is, for investors who don't do this for a living, it's really, really difficult to beat the indexes.
Well, they're not going to. I mean, and you know, one may be lucky for a while, but the beauty of it is, you're going to do wonderful with American industry. You don't have to be an expert, and the experts aren't going to do it in large measure either. But you're going to do fine. So it isn't like I'm saying, you know, the know-nothing investor is just going to be left out on the street or anything. They're going to get a great result. And you know, I've mentioned the past. When I die, I've told my wife to have 90% of her and the trustee to have 90% of it in an index fund. It will do better on balance than what they will get if they go to professionals.
Because?
Because the professionals don't know how to, after fees, they don't know how to get a better result. If you take half the people in the country and they don't do anything, they just own the average, they're going to get average results, right? And if they don't have any expenses, they'll get those both gross and net. The other half, by definition, have to do average. If that other part is, I mean, the average is left for them, and they're going to incur all kinds of fees, and they're going to do way better, way worse than the people who do nothing. And I made this bet in order to just illustrate it, and you know, the difference is incredible. I mean, the amount of money that people have wasted on getting investment advice is just ridiculous in this country.
Yeah. You mentioned that there are 10 managers maybe in your lifetime you have met, but
Right.
I want to let Joe in on this conversation, and then we'll come back to that point, too. Joe, go ahead.
No, I was just going to say a lot of those hedge fund guys are assholes. Becky, I'm going down with you, baby.
I am never going to hear the end
I'm
of
going
this.
down with you. I'm going down with you.
Thank
I'm
you, Joe.
on record. Sink or swim. If we're going to sink.
I can see next year I'll be doing this. I'll be doing this show by myself next year.
Seriously, 2 and 20,
Yeah.
Warren. 2 and 20, and they can't beat the index. I mean, that's something that you were showing, and I'm glad someone finally showed that. I mean, some of them are good. Some of them, year after year, are good. But there's a lot of naked emperors there that charging 2 and 20, and they have a couple of good years, and then they give it all back. They keep their 2 and 20, but no, then they lose it all for the people that are there, right?
No, the 2 and 20 is going to make a lot of people rich, and it's going to make very few investors rich. And it's actually kind of, it borders on obscene. As I said in the letter, I've known 10 or so people that, with modest amounts of money, I'd bet a lot of money that they would do better than average. And I say that there are hundreds and maybe even thousands, but there are thousands and thousands of hedge fund managers. Charging 2 and 20 is just ridiculous. And you don't get better because you charge a lot. I mean, that does not make you a better judge of securities or anything like that. And so the good salespeople overwhelmingly are the ones that attract the money rather than the very few who are extraordinary at managing money. Phil Fisher, who wrote that book, Common Stocks, he was going to do better than average. Charlie was going to do better than average in life, in investments. Bill Ruane, a friend of mine, was going to do better. There have been a few, but they're very, very few. And then only if they work with fairly modest sums of money.
Is that why you don't want to tell us anybody we could actually invest with right now?
Well, partly being 86, my crew is, the fellow you never heard of, Herb Wolf. Probably if I'd picked one guy to manage money, I would have had Herb do it. But Bill Ruane was outstanding, and I recommended him to my partners, and my partner Sandy Gottesman, and many things. There's no question he was going to do better than average in life, but very, very, very few people. And when we were looking for a couple of people to hire at Berkshire, I think you were on that trip, CNBC was, when I had hundreds and hundreds and hundreds of applications from people. And the truth is, I let anybody in the world that wanted to challenge me 9 years ago come up with $500,000 for their half of the bet. And all of these guys who make billions of dollars a year, they didn't want to put up $500,000 and bet on themselves. It's amazing what's happened in investment management.
Joe?
I have one more philosophical question, Warren, and it goes against what you normally speak to. But just in terms of looking at the market and whether it's had like a run where it's done too well and it needs to regress to the mean, or where it hasn't done well enough and it'll come back. If you look at an 8-year analysis, let's say it's tripled in 8 years, that's like 16% a year or something, I think, because it doubled twice, or no, not quite, but if it tripled, that's one way of looking at it. But if you go back to 1999, 17 years, it's only doubled. So that's only 4% a year. So which is it? Has this market gotten ahead of itself because it's tripled in the last 8 years, or it's taken forever to go from 10,000 to 20,000, so we aren't necessarily in this rarefied air? Do you have an opinion on that?
Yeah. Well, I would bet my life. Well, it doesn't mean much when I'm 86 to bet my life on a 30-year bet, but I would bet my life that stocks over 30 years outperform the 30-year bond. I would come close to doing it, betting that over 10 years they'll do better than the 10-year bond, versus the 1-year bond or 2-year bond. I have no idea whatsoever. But stocks, if you look at American equity, basic business of America, American equity earns a tremendous return on tangible net assets. That's what the business is about. That's what the farm is producing. Now, a bond is limited to what it can produce. But when you say reversion to the mean, I'm not sure what the mean is. I mean, the mean is going to be based upon returns on equity, the amount of equity reinvested and reemployed. And I would say there the prospects are so much better than in fixed dollar investments that, you know, admittedly, I liked stocks a lot better a few years ago, and I've said that on this program. But stocks versus bonds right now, it's not close. Now, bond yields can change a lot. If bonds go to 15%, I may be recommending bonds.
Warren, were you considering yourself among those 10 people that you thought could outperform indexes? Did you always know that you were going to be able to be?
I always felt I would. Yeah, it's kind of disgusting, but I really did. I mean, I retired when I left Graham Newman with $175,000, and I thought that would be enough to provide me a good living, you know, the rest of my life. And I had a couple of kids then, and no, I thought I was right for this business. Now, I thought Charlie was right for this business. I thought Bill Ruane. I mean, I knew 10 or so people, Walter Schloss, and I didn't think they were the smartest guys necessarily in the world, although maybe Charlie is, but I thought they were well adapted to the business. People have different talents. I mean, you look at chess champions or bridge champions, sometimes they're not so good in other areas, and I'm wired for this business to some degree, so, and I felt that, yeah. And I learned from the greatest teacher you could have.
What would you have done? What other jobs did you consider besides going to work for Ben Graham?
Well, when I got out of Columbia, I only applied for one. I went to Graham and said I'd work for nothing, and he turned me down. But I did go down. I did go down to Merrill Lynch. I went down to Merrill Lynch, and this woman said that she put me in this little room to wait, and there were a couple guys in there already, and they got called up. But then there were about 3 or 4 that came in after me, and these guys were all really fat, and they kept getting called in ahead of me. And I finally decided Merrill Lynch had some minimum weight requirement, so I left. and if they'd called me in earlier, I might be working for Merrill Lynch today. But I just got tired of all these fat guys going ahead of me. And I thought I must have been a pro football tryout or something. So I only weighed about 135 or 40 pounds at the time. So I decided that there was some requirement at Merrill that they hadn't told me about.
And oh, how different your life might have been.
It'd been different. Yeah.
You keep talking about the 10 guys, maybe 10 people,
yeah,
maybe that you've seen that could outperform. Is there anybody who's actively managing money today who investors can still get in with in that group of people?
Well, I'm sure there are, but they will only be effective in all likelihood with fairly modest sums of money, and of course they'll attract.
Yeah, the reason I keep coming back to this is because that's got to be a question everybody's saying.
Well,
who do I go to beat the average?
Yeah, I hired 2 guys who I thought were very good, and they are very good. Yeah, but they're running 10 billion each, and they would do better if they were running 1 billion in terms of percentages than they will. It's just that we have a lot of money around. So, but added funds work wonders for the general partner who's getting the 2 and 20, and they're totally against the interests of the limited partners beyond the point.
There was a question that came in from a viewer, and I don't know the number on it. And you guys, if you can find it, the gist of the question was, does the market still have plenty of Geicos out there that you could find and that are great investments that are going to continue to grow phenomenally? Or is it just a different market, is a different time?
It's tougher than it was, obviously, 50 years ago. I mean, my best year actually was 1954, so you can see how far I peaked very early. But I was working with tiny amounts of money and in a market that was not combed over the same way as presently. So there are way more people looking to compete with, and I still think, because of temperamental differences, I think there are a fair number of people that with small amounts of money can do well. But the chances that the average person is going to pick them out, or that the person sitting across from you trying to sell you as that person, is betting against the odds, significantly against the odds.
You mentioned in the letter, though, that's something that your wealthiest friends just don't want to hear, though.
It's a very interesting phenomenon. I've talked this way, and people with small amounts of money say that sounds good to me, and then they just go and they buy index funds, they keep buying them, and they've done better than the people who have gone to hedge funds. But if I say that, I get asked various pension funds. Sometimes they're local. I've been asked by very big retirement funds, some other states, and I say the same thing to them, and they basically can't stand the idea that their big money won't buy special performance. And of course, they get called on by these people all the time. You know, and
the hedge fund guys,
good salesmen. Yeah, they're going to fall for good salespeople. And what really gets me is sometimes they hire consultants. They say, well, I don't know enough to pick good managers, but I know enough to pick a good consultant. I've never quite figured out why, if they can't figure out who a good manager is, some guy comes in and says, well, I'm a good consultant. So it's really sad, but they're really outclassed in many cases by the salespeople. I mean, that's true in a lot of fields, but in investments, you're talking big money. And somebody's got $1 billion, they want to have a family office, or they want to feel special. And the truth is, you don't need to be special.
Okay. Warren, if you don't mind, we're going to slip in one more quick break. When we come back, folks, we're going to talk a little bit more with Warren Buffett about some issues concerning the markets and some of the securities that he's been bulking up on. You're going to want to hear this, so stay tuned. Squawk Box will be right back. Welcome back to Squawk Box, everyone, where we are live in Omaha, Nebraska with Berkshire Hathaway's chairman and CEO, Warren Buffett. He's been answering questions for the better part of the last 3 hours. And Warren, again, thank you for your time today.
Thank you.
Before we go, I'd like to make sure we hit a few points for people who weren't up 3 hours ago, right at the very beginning of things. The one question everyone asks me when I come back from talking to you on one of these things is, what does he think about the stock market right now? There are a lot of concerns from investors who have watched things run very rapidly over the last few months. We've watched the Dow go past 20,000, watched the S&P go past 2,300. And there are investors who feel like, wow, I missed my chance. I've been sitting on the sidelines. Now I have to wait for a pullback. What would you say to those investors?
Well, I don't have the faintest idea what the stock market's going to do tomorrow or next week or next month or even next year. I do know that over time, and we'll talk 10 years or something of the sort, that equities will do better than bonds, which is the main alternative, or bank deposits or whatever it may be, fixed dollar investments for people. And they're not going to be able to pick the time to come in. I don't know how to pick the time to come in. I bought a lot of stocks in the last couple of months that may turn out that the stock market goes down 20% or 30%. But that won't bother me if I like the businesses I bought.
You know, there are a lot of people who think you need to be balanced. If you're going to be in stocks, you also need to have balanced in bonds, maybe 60-40 or 80-20 or whatever it may be. And I have money in Fidelity Retirement. I have everything in S&P 500 index funds, like you've written, like you've told people to do, with the exception of Comcast shares, which I own. But everything else is in S&P 500 index funds. And I get a red signal back from Fidelity saying, this is dangerous. You should not be invested in stocks. Are they right to warn me off?
No, I think that's totally wrong. I mean, it's been obviously you shouldn't be invested in stocks with money you might need to use.
These are retirement funds.
Oh, yeah, but if you're going to need, you shouldn't borrow money against stocks, and you shouldn't. If you're going to need some money for college or something in a year, you don't want to be in stocks because you don't have any idea what stocks are going to sell for in a year. It's inappropriate. The stocks are safe for the long run, and they're very unsafe for tomorrow. If you call unsafe being, will you be bothered by a decline in market prices? But Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I mean, but I didn't know it on borrowed money. I knew it was going to be worth more over time. American business is going to be worth more over time. You know, that's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are. But if you think you can jump in and out, or that you know the time to come in, I think you're making a mistake.
In my lifetime, you said you wouldn't be surprised to see the Dow go to 100,000?
Yeah, well, you're probably, what, 30, 35, and you got another 50 years or 60 years left. And
you're kind.
You'll see it.
Yeah.
No, I mean, it's going to go. I mean, they retain earnings every year, just retained earnings. A fellow named Edgar Lawrence Smith wrote a great book about that in 1924. It was the rationale for the great bull market in the 20s. But he pointed out how retained earnings actually add to values. And if you owned a private business and you retain the earnings every year, Berkshire's done that. And it gets to be worth more money, and that's what's happening in this world.
You told us earlier in the program you've put probably $20 billion to work just since around the time of the election because you've liked 2 areas. One of those areas is Apple, one is the airlines. And we do have a question that came in from a viewer, James Lee, it's T51, folks, who says, why do you believe that managements in boom and bust industries like the airlines will act prudently and rationally for a long time?
Well, that's the question, but it's certainly easier to act rationally when you're doing 80+% load factors than if it was a lot less. So the big problem is if they get too many airplanes around, you can be sure that it'll be a lousy business for a while.
Does that mean that's a number you watch, kind of like the canary in the coal mine? Is the load
Well,
factor
you can see
itself?
what the orders are and all of that, and deliveries are expected to be, and airline usage, seats sold will go up over time. Not necessarily dramatically, but that will increase. So it isn't like demand is ever going to go away. If you get too much supply, you got a problem.
Speaking of supply and demand, crude oil is another one that we've watched very closely. I know you mentioned in the letter that Marmon Industries, things like the rail car, the leasing business that was there, it's been down significantly. You said it was not just because of crude oil. What are the factors that go into that?
Well, crude oil is a factor, but general heavy industry has not been super strong. It's very interesting. Since the fall of 2009, we've had about a 2% a year growth, year after year. And people get more optimistic than that sometimes, and strengths and weaknesses have moved a little through the economy. But the oil business, it looked terrific a few years ago, and more oil products in the United States are going to move with $100 crude than move with $50 crude. And people got very excited about ordering tank cars a few years ago, and then they've got less excited. Actually, there's been a little pickup lately.
I can't believe we've gotten to this part in the program and we haven't asked you your take on the economy. Where is the economy right now?
The economy is, everything I see has been the same since fall of 2009. It keeps moving ahead at a couple percent a year, which is terrific, incidentally. Not as terrific as 3% or 4% would be, but if it just stays at 2%, you'll add in one generation 19,000 of GDP per capita to our present economy. We'll have so much more stuff then than we have now. It'll be fabulous, one generation away. So your kids are going to live better than you do. But people would rather have 3 or 4, and maybe we'll get it. But 2, we're moving forward.
We just spoke with Treasury Secretary Mnuchin last week, and he said he sees a way for us to get to 3% growth based on a few things. If it's tax reform, if it's cutting regulations, some other things that go along with that. Do you see us getting back to 3% growth?
I just don't know. I mean, I wouldn't bet on it, but 2% will do terrifically. 3% be better. Anything they can, well, I shouldn't say anything, but a lot of policies that might bring it to 3%. If they do, I'm all for it.
What do you think would help us improve growth?
Well, productivity is the only thing that gives you growth. I mean, if we hadn't changed productivity since 1776, we'd be living like we were in 1776. If 80% of the people had to be on the farms to feed us, we wouldn't be producing much of anything else. So it's all productivity over time that counts.
We got a lot of people who wrote in about artificial intelligence and robots and where you think they are moving along. Are they hurting our productivity?
Yeah, I don't really know anything about robots, but I'll put it this way. If you eventually got the world so one guy could push one button and everything that's being produced now would be produced from him pushing that button, it'd be a better world. Now, you'd have to make sure that guy didn't keep all the output. But the idea of getting more productive, it benefits everybody. And I shouldn't say it benefits everybody, it benefits society. It can hurt individuals in their given industries. But we should long for more productivity. That'll give fewer hours worked. It'll give more output per capita. It'll give better living for people. And that's what we've done, actually, in this country. We saw it dramatically in farming. I mean, it's unbelievable what has happened in farming. And we now have 2% of the population working on farms, doing way better than when we had 80%. But if we didn't have tools and fertilizer and all those things, we'd be an agrarian economy and we'd be living like we did in 1776.
Very quickly, the dollar has continued to climb. Is that good news or bad news for Americans?
It depends whether you're an exporter or an importer. It makes it very tough if you're exporting. But it's, with interest rates being what they are in Europe, compared to here, the dollar just has gotten stronger. And when people tell you what the dollar is going to do, they'll be very careful. I mean, it just suggest they take up currency trading for a living and see how they do.
Warren, I want to thank you very much for all your time today.
Thanks for having me.
Again, this is our 10th annual Ask Warren show, and we can't thank you enough for hosting us and having us here.
It's been fun.